Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for Kiesel, Weingarten, and Warfield. This is problem 23-8. This is from the textbook 17th edition by authors Don Kiesel, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the text or of Wiley. All right, let's go ahead. And before we say thank you, let's go ahead and take a look at our problem for today. So this over here is asking us to go through and compute a statement of cash flows under the direct and the indirect methods. So what I'm going to go ahead and do over here is we're going to do the indirect method first. And this is kind of a strategy I always like to deploy. So just give me a moment while we get this set up. Okay, so the first thing we always do when we do a statement of cash flows is we're always going to go ahead and do for Sharp or Sharp company statement of cash flows for the year ended 12/31/20. So we're going to have cash flows from operating activities, net cash blank operating activities, cash flows from investing activities, net cash blank investing activities, cash flows from financing activities, net cash blank financing activities. And then over here, we're going to have lastly our total change in cash. And our total change in cash is going to be 19,000. Our beginning cash balance. Ooh. Beginning cash balance was 51,000. So our ending cash balance is going to be $70,000. Okay, and then we're going to have non-cash transactions. Okay, so the reason why I'm going to do the indirect method first is because for myself, I never really have used the direct method in practice, only for CPA exam. And it's just something where the indirect method has to be shown as a supplemental. The only difference between the two, between direct and indirect, is right here is operating. Everything else is the same. So, and also I just want to kind of give us all a little bit of a quick heads up on this, right? So I've made the, I've gone through and I've made this, gone over here and I've done my skeleton. Next thing I'm going to go ahead and do here is I'm going to have my cash, operating, investing, and then financing. Okay, so the other thing I'm going to do is we're going to go ahead and put in the opening balances. So accounts receivable, beginning of 130,000, ending of 155,000. And I'm going to also put over here this allowance for doubtful accounts. I'm going to kind of, I want to put these where it relates to the typical balance, ADA, inventory. My inventory was 61,000 and then 75,000. My debt, investments, AFS, available for sale, opening was 85, ending was 55,000. My equipment, opening was 48, ending was 70. My accumulated depreciation on the equipment, opening here was 14, ending was 21. My buildings, 145, ending is 145. My accumulated depreciation on the buildings, Over here was 28 and then 37. And then my land was 25 and 40,000. I've dealt with the allowance for doubtful accounts. I've dealt with the accumulated depreciation balances here for these credit balances. Accounts payable, opening was 60,000, ending was 66,000. Okay. Income taxes payable. Opening was 10, ending was 12. Long-term notes payable. Opening here was 70, ending was 62. Common stock, opening was 260. Ending was 310. Retained earnings, opening was 92, excuse me, opening was 95, ending was 92. Now, the thing that I want to kind of say before I go through and do this is my, I don't know, my fourth or fifth video in cash flows that I've made basically for this sequence of videos from chapter 23. And what I also want to say is that I may be going through these a little bit more quickly than you would like me to go through. Therefore, with cash flows, really what I want you to just kind of keep in the back of your mind is that everything here that you're going to be seeing, if I go through this a little bit too quickly, start basic, right? Don't jump into the water with the sharks until you've gone through and have really gone through and practiced even just very basic questions, right? When I teach this at a financial accounting level, the way I do it is I start very simplistic, maybe just a couple accounts, because you have to go through and follow this methodology. So, or at least you don't have to follow anything I do. It's just, this is the way I do it. So over here, let's go ahead and take a look at the additional data because we want to deal with that first. So equipment that cost 10,000 and was 60% depreciated was sold in 2020. Interesting. Does it tell us what our cash proceeds were? Well, I love this. Okay, we're gonna play the guessing game. Okay, so here you go. So when I sell equipment, what do? Right? I've got loss, balancing, and I'm going to create a journal entry. So my first step, make the skeleton. Second step, I am going through and putting the balances into T accounts. My third step is going to be to deal with the additional information first. Balancing, accumulated depreciation, cash, equipment, gain, balancing. Okay, so for this first one over here, it says, oh, equipment that cost 10,000 and was depreciated at 60% was sold in 2020. And this is equipment. And it tells us over here that we had a loss on sale of equipment. Because we're not given the cash, I have to assume that this loss relates to this equipment sale. And then therefore, the amount of the cash being received is $1,000. And by the way, I would never do it this way. I would give you the cash, accumulated depreciation, equipment, and ask you to compute the gain or loss. But we're doing it this way. It's fine. Always good to trick the brain. So right over here, what I'm going to go ahead and do is I'm going to go ahead and post this into the T accounts. So over here, I've got equipment. I'm crediting equipment for 10,000 because that's what I sold it for. And let's go over here. Accumulated depreciation on equipment was 6,000, or that's 60% depreciated. I'm taking that $10,000 amount and multiplying it by 60%. My sale of equipment over here is going to be $1,000. And I'm going to go ahead and add, or I'm going to go ahead and debit loss on sale of equipment. My loss on sale of equipment was 3,000. Okay, so that is the first piece of additional information. Cash dividends were declared and paid during the year. Okay, so what I don't know, actually, what I do know is this. What was my net income? Okay, so right over here, if I'm looking at cash dividends, where would I kind of go through and see this? Well, I would see over here beginning plus net income minus dividends is going to give me my ending retained earnings. So over here, let's go take a look at retained earnings. Now, if I just said, oh, well, dividends are 3,000, that may or may not be right, but I don't think it is. So what I want to do is say, okay, well, retained earnings, I had net income of 67,000. So right over here, I've got 67. I'm going to go ahead and do the opposite to cash, and this is going to be my net income. So my net income over here was at 67. Okay, so the difference between here, or 95 plus 67 minus 92, that means I must have paid $70,000 in dividends. Okay, so with dividends, I'm going to go to the financing section. I'm going to say payment of a dividend. And so because they said they were declared and paid, I do the opposite to cash, and that's how I go through and deal with that particular item. Wow, try to mess me up. It's good. Okay, common stock was issued in exchange for land. Okay, so let's take a look at land. It went up from 25 to 40. I have to assume that that increase was related to the common stock issuance. So what I'm going to go ahead here and do is I'm going to basically say, okay, land 15,000, common stock 15,000. So over here, my common stock is going up by 15. Okay, we're going to make this a new color. And land is also going to be here for 15, assuming there was no other transactions involving land. Now, this is what we call a non-cash transaction. So we're going to say over here, land of 15,000 was acquired by issuing 15 of common stock. So I describe what happened in the additional information, and I'll be good to go. Okay. So now let's go ahead and look at the next one over here. Debt investments that cost 35,000 were sold during the year. Now, here's another tricky one right over here. So my debt investments, right, went from 55 to 35, or they decreased by 30,000. Okay. So let's go over here and see this. So debt investments were 30,000. Okay, so I sold debt investments, assuming that cost me 35,000. Debt investments that cost 35,000 were sold during the year. Now, how much cash did I receive? Well, I had a gain on sale of investments. So the gain on sale of investments, this would show up as a credit balance. So the cash from sale of investments would be right over here at 50,000. So again, if you have, just remember this equation. If I have a gain, it's going to show up as a credit. It's like income. But over here, right, I sold the debt investments cost me 35 and I sold them during the year. So I have to look at the income statement and say, oh, this was 15 grand. So I must have received 50,000 in cash. Okay, so right over here, I'm going to go ahead and I'm going to say sale of debt investments. And this is going to be cash received, or 50,000. The gain is going to show as a negative amount or a credit. So this is going to be a gain on sale of investments. Okay. And then over here, I'm going to go to debt investments available for sale. I'm going to have a credit over here of 35,000 because that's what those investments cost me. Okay, there were no write-offs of uncollectible accounts during the year. Okay, so what that is telling me here is that when it comes to the allowance for doubtful accounts, and I want to go through and check something really quickly. Even I have to use Chegg, aka Textbook Solutions, from time to time to make sure that I'm not off of my rocker. Okay. Let's see here. Problem 23.8. Okay. So they're doing it the same way. Okay. Well, for me, what I like to go through and do, and let's just kind of go through and talk this through real quick. So when we look at accounts receivable, the way that I would prefer to go through and do it is I would say, okay, AR increased by 25,000. The allowance for doubtful accounts increased by 2. So I would say over here, increase in accounts receivable would be 25,000. Over here, bad debt expense would be over here at 2,000. That's how I would prefer to do it. The book does it a little bit differently, and I can kind of see why, because when it comes to the direct method, I think that you would have to go through and take this into account. But if we say accounts receivable net, and we would say over here, my beginning balance is going to be 130 minus 8,000. And then my ending is going to be 145, or basically my ending is 155 minus 10, or 145. My beginning is over here. And so to balance this, I basically need 23,000. Now, this in effect, if I was doing the opposite to cash, I would be showing this over here at 23,000, right? And so, but my preference is when I go through and do this, I like to show it this way, but the textbook is showing the answer of an increase in accounts receivable net. So they're basically, what they're doing is they're basically combining these accounts, and they can choose to do that. I would probably settle the dispute by going through and looking at SEC filings. Okay, I've dealt with all the additional information before I go over here. So the last part, there were no write-offs of uncollectible accounts. So what I'm now going to go through and do is analyze the rest of my accounts. So inventory, do the opposite to cash. This is going to be 14 grand. This is going to be an increase in inventory. Okay, so over here, debt investments available for sale. 85 plus 5, excuse me, 85 minus 35 is 50. So to balance this, I'm going to need a debit for 5. So this is going to be over here. This is going to be a purchase of available for sale investments. Okay, this goes in the investing section. Equipment, I bought, basically I had 48, I sold 10, got to 70. So this is going to be 32,000, or 48 plus 32 minus 10 is 70. So this over here is going to be a purchase of equipment for 32. Accumulated depreciation on equipment, 14 minus 6 is 8 compared to 21. So this is going to be 13,000. So 14 plus 13 minus 6. I do the opposite to cash. And so this is going to be depreciation expense. Again, if that's new to you, watch the other videos. Buildings is balanced. Accumulated depreciation on the building. So building depreciation expense. We call this equipment a depreciation expense. Okay, so this over here is going to be 9. My land account is balanced. Accounts payable went from 60 to 66. So this is going to be an increase in accounts payable of 6. Long-term notes payable. This went over here from 10 to 12. So this is going to be an increase and long-term notes payable. So this over here is going to be a debit of 2,000. We would just call this issuance. Excuse me. Wow. My God, Tchaikovsky, what is wrong with you? Let's stop there. That's not, my eyes are going. This is income taxes payable, Tchaikovsky. Good job. Okay, so right over here, we're going to go ahead and say income taxes payable. I never use this account for cash flow questions. Okay, so this is an increase in income taxes payable. Okay, so long-term notes payable. This decreased by 12,000. We're going to put this one in the financing section. So we're going to call this over here. This is going to be a payment on long-term notes payable of 12,000. For my common stock, right, I've got 260 plus 15. The difference between these over here is 35,000. I'm going to say over here, issuance of common stock. Okay, and this is going to be over here for 35,000. All right, so now the moment of truth, the big reveal. Who is the Masked Singer? Well, let's try now, figure out if it's Jerry, Maury, Geraldo. Let's figure out that Masked Springer. Okay, so right over here, my net cash provided by operating activities is 48. My net cash provided by investing activities is 14. My net cash used in financing activities is 47. If I go through and add up these various different accounts, so 48, investing is 14, financing is 47. If I add up these accounts, I have no idea whether or not this answer is correct. Let's have some fun though. Go ahead, drum roll, please. My answer here is 15. I'm off by 19. I'm off by $4,000. Let's go through and see where we might be off. Usually what I make the mistake on is, as I'm going through and doing this, is I transposed one of the numbers incorrectly. So the cash did go up by 19. My accounts receivable, 130 to 155, ADA 8 to 10, inventory 61 to 75, debt investments available for sale went from 85 to 55. Equipment went from 48 to 70. Buildings went from one with basic area at 145. Accumulated depreciation on equipment 14 to 21. Buildings 145, 145. Accumulated depreciation on the building was 28 to 37. Land went from 25 to 40. Accounts payable went from 60 to 66. Income taxes payable went from 10 to 12. Long-term notes payable went from 70 to 6. Oh, Tchaikovsky, what did you do? Right, I didn't check to see if this could balance. So 70 minus 12 is 58. That's not right. It should be 8,000. And if I put 8,000 over here, children, oh my goodness, good night moon, good night cow jumping over the moon, good night bears, good night people sleeping in chairs, right? We just got it, right? Sleepy Joe Bennett is made it happen. Isn't that exciting? So right over here, right? I can read Brown Bear well. I love that book. So right over here, you've got 19,000 and we actually balance. And it's because I screwed up, right? This is why it's so important to check your T accounts, right? You got to check those T accounts. All right. So now that I've gone through and I've done this part over here, let's go ahead and finish up the statement. And then we're going to try to wing it through the direct method. Okay, so right over here, we've got net income. I'm just bringing all of this down over here. And let's bring this down a little bit further. Okay. So increase in a income tax payable provided by operating activities. Okay. So right over here, we've got net income of 67, 3, 2. Okay, this is not right. This is depreciation building. Okay. Increase in inventory. It's a credit, so it's going to show as a negative. Increase in AR, gain on sale of investments. So right over here, I would say I've got over here, I've got a total of 48,000. Cash flows from investing. I've got sale of equipment, sale of debt investment, purchase of available for sale securities. And these are going to be negative amounts because they're credits. Okay, so net cash provided by investing activities. 14. And over here for financing, I've got payments of dividends, payments of long-term notes payable. So payments of dividends going to be negative 70, 8, 35. Then we're going over here to 43,000. So this is going to be net cash used in financing activities. I add up these three and these balance. So why did I do this part first? Because now what I have to kind of go through and do is to figure out our next step. So the trick that I learned from if you take a look at the video for exercise 25, 23.5 and 23.6, the way I kind of did this is that when we're doing the direct method, we're taking items here and we're basically saying, okay, what relates to these different items? So we've got services revenue. So when we have services revenue, okay, what we're doing is we're looking at we're trying to convert when we're doing the direct method, right? Again, so let's take a step back for a moment. When I'm doing the direct method, the only thing that is changing is the operating section. And I know that the answer has to be 48,000, right? That's the most important thing, because I just figured out what that answer's got to be. So when I come over here, and the way I kind of did this is I said, okay, so my services revenue is I have to convert this to cash from sales, right? So what I do is I said, okay, I've got 840. And then what I do is I look at the T accounts. Now, if I look at this AR, this looks like in this case here, it's like, well, it went down, but it's really a matter, well, we would be debiting cash because we actually collected money. So it's showing up here as a positive. And with AP, I'm actually showing this over here. Will AP increase, but it's almost like these are operating expenses. So in effect, I'm like borrowing money, so I paid less cash out. And I know that seems kind of weird, but the way I want you to go through and do this is to say, like, if it's a credit on the asset or liability account, I'm going to go ahead and add it. If it is a debit, I'm going to go ahead and deduct it. So let's go ahead and see if we can get that methodology to work over here on our new question. So right over here, when I'm looking at the direct method, okay, so for sales revenue, okay, my sales revenue. So this is my direct method. So my sales revenue was 950,000. Okay, so what I'm going to really do here is what I said was, well, let's take a look at AR net. My AR is actually going up, so I'm not actually collecting that cash. So I'm going to say less AR net increase. So over here, I'm going to show that as a negative amount, and this is cash from sales. So kind of look at this. While my AR went up, that means I didn't collect it. So that's my cash from sales. Let's now go over here to our cost of goods sold. Okay, so what we're going to do with cost of goods sold is we're going to be looking at two different accounts. My cost of goods sold over here was 600,000. Okay, so my cost of goods sold was negative 600,000. Okay, now with cost of goods sold, it's going to involve two different accounts. And let's see if we can apply that same logic. So over here, I'm really trying to say, what was my cash paid for cost of goods sold? So I kind of borrowed here on the inventory. So this is also going to be less increase in inventory. So this is going to be a negative 14,000. Okay, so also though too, I need to look at accounts payable plus, or so I should just say add because it's a negative and increase in inventory. We'll just leave it like this. And we'll say increase in accounts payable. Okay, so we'll just say AR net. We're just going to get rid of that less. Just follow what's going on in the T account, right? So over here, if it's a debit, it's going to be a negative amount. Over here, it's a debit, it's a negative amount. Increase in AP, it's a credit, so it's going to be a positive amount. Okay, so I probably may have screwed this up, but we'll see if we got it right. So 600,000 minus 14 plus 6, and I get 608. Go down over here, right? I want to look over here at my other costs. Operating expenses includes depreciation expense and bad debt expense. Aha. Okay, so my operating expenses were over here. We're at 250,000. All right. Okay, so I'm trying to figure out my cash. So this is cash paid for COGS. I'm trying to figure out my cash paid for operating expenses. Okay, so when I look at this over here, I notice that this includes depreciation expense and bad debt expense. Okay, now I get, oh, the big payoffs come, Tchaikovsky, great. Okay, so what I'm going to do is I'm going to add back. So over here with the bad debt expense. Okay, bad debt expense. Okay, because it's a credit, I'm going to show this as a positive amount. Depreciation expense, it's going to be in two categories. It's going to be over here of 13,000, and on buildings, it's going to be 9,000. I'm showing those as add backs, right? Because I'm doing the opposite to cash, so that's what I'm doing here. So my depreciation expense, equipment, depreciation expense, buildings. So when I look over here, 250 plus 2,000 plus 13, and this is really adding it back, I'm getting up here as 226. Last one I have to go through and look at is for income taxes, and my big blunder on that one. So I've got income tax expense of negative 45,000. And I want to see what happened with my income taxes. So my income taxes over here, they increase. So I'm going to basically show this as an add back or a positive 2,000, which will decrease the amount of the income tax expense. Income taxes payable. So this is going to give me the cash paid for income taxes. Because if I see this over here, if my payable went up, it basically meant that I didn't pay that $2,000 this year. So my cash paid for income taxes. When I go through and I add up these different amounts, uh-oh, what did I do wrong? I don't know. Uh-oh, SpaghettiOs. 950. Oh, wow, Bennett, look at this. Here's a big mistake I just made. Okay, the big mistake I made is I was using this AR net. Okay, because we're breaking this out with bad debt expense, I'm going to go over here with AR. Okay, so by the way, this AR net just totally screwed me up. So kids at home, don't listen to Uncle Kiso. Just use what I did in this original question. So here, this is going to show as a negative 25,000, right? Because my AR went up means I didn't collect it. So my cash from sales is 925. Wow, that pisses me off. So this is 48,000. Oh, does that 48,000 look familiar? No, it's right over here. So look, kids watching at home, don't try this at home. Yes, I do want you to try this at home, but be rest assured. I think the only company I've seen, and let me just pause real quick. Okay, so here's CVS, right? So this is CVS Pharmacies. And if we look at CVS, what you'll see is they have cash receipts from customers, cash paid for inventory and prescriptions. So this is what they go through and show. They're using the direct method. This is one of the only companies that I know, and I want to thank a student of mine from years ago. It was Katie. I want to thank her for pointing this out to me. Let's take a look to see if we can find the indirect method. Let's see if we can find this. Let's say cash flows. Oh, okay. Hold on. Okay, so sorry about that. So CVS is the company that does use, they use the direct method. I was actually going through their financials to see if I can find their indirect, but I'm actually running out of time today. But so with the direct method, here's what the best thing I can tell you to do. Split up the accounts like I showed you here. Don't use this methodology. I would show bad debt expense separately. The fact that they're doing it here, I think that their solution is wrong, but that's, again, my opinion. Over here for cash flows, this is what I want you to do. If you're doing the direct method, take the income statement amounts, right? And then over here, what you're going to do is for receivables, right? If it's a debit, reduce it. And on all of these different accounts, let's see if we can make this work. If it's a increase in inventory, if it's a debit, reduce it. Increase of AP over here. If it's an increase or a credit, add it. Bad debt, right? Over here, allowance for doubtful accounts. It's a credit, we add it. Depreciation expense building, depreciation expense equipment, add it. And then income taxes payable over here. This is a credit for income taxes payable. So we're also adding it, right? But just remember here, you're adding it to a negative number, but we can kind of, if we use that kind of thought pattern, that's how we can get through cash flows, at least on the direct method. So in any event, I want to thank Wiley for allowing me to use their material and hopefully not bash them too much. But if you're watching there, Wiley, we got to do some work on improving some of those questions. But I want to thank all of you for joining me here today on this endless odyssey through intermediate accounting. And we have an 18th edition coming up soon. So in any event, I want to thank you for being with me here today, and I look forward to seeing you on the next video. Have a great day.